Everyone, happy December to everybody. Wow, it is December. We're literally a month and 27 days away from full circle. Now, what we're going to talk about here in this one, real quick, this is going to be a real short one. We're going to talk about exhaustion gaps and a little bit about gaps in general. Let's take a look. Introduction. A gap occurs when a security's price jumps between two trading periods, skipping over certain prices. A gap creates a hole or a void on a price chart. Because technical analysis has traditionally been an extremely visual practice, it is easy to understand why early technicians noticed gaps. Gaps are visually conspicuous on a price chart. Consider, for example, the stock chart for Huntington Bank shares or H-band in Figure 1.1. A quick glance at the price activity reveals 4 gaps. So we take a look at this. Now this is on a intraday daily chart here. We have 4 gaps, gap A, B, C, D. Don't necessarily agree with a lot of the language here, but I do have an idea of what's going on. Just as a security's price can gap down, it can gap up. A gap up occurs when one day's low is greater than the previous day's high. Early technicians did not pay attention to gaps simply because they were conspicuous and easy to spot on a stock chart. Because gaps show that a price has jumped, they may represent some significant change in what's happening with the stock and present a trading opportunity. A technical analyst watches stock price behavior, searching for signs of any change in behavior. If a stock is in a strong uptrend, the analyst watches for any sign that the trend has ended. When a stock is in a consolidation period, the analyst watches for any sign of a change in behavior that would indicate a breakout either to the upside or to the downside. Spotting these changes leads to profitable trading, allowing the trader to jump on a trend, ride the trend, and exit once the trend has ended. Gaps can be one indication of an impending change in trend. Now, the gap that I have been using with my membership with the strategy is exhaustion gaps, technically speaking. However, I believe due to the current situation with no liquidity, the repo demand, and all that stuff, we're actually seeing common gaps occur as far as trend reversals, which should not happen. Now, as its name sounds, an exhaustion gap occurs at the end of a trend. In the case of an uptrend, price makes one last attempt to move higher on a last gasp of breath. However, the trend is exhausted and the higher price cannot be sustained and it moves down. Same thing applies in reverse. Let's say a stock, I don't know, has been getting beaten down all year long. We have a gap down all of a sudden. That's a good indication you should buy and get into that security because, again, my theory, common gaps have become exhaustion gaps. By definition, common gaps occur in illiquid trading vehicles, are small in relation to the price of the vehicle, or appear in short-term trading data. Well, clearly the first one is what's occurring, and it's happening on a broad market scale because there's no liquidity in the entire market. So go look around the market. There's gaps everywhere. So why is this? Likely due to liquidity. So what does this do on the grand scheme of things? Likely, since they have to put all their liquidity in certain spots, there's probably a lot of opportunities being created with these exhaustion gaps, like the one we played today. Bzun. I've been getting a lot of screenshots from you guys showing me great gains today on this one. Good shit. This one was a very easy one. As you can see, we gapped down yesterday. Volume was insane compared to the average. We played it. We rode the wave up today, and it was easy money. That's what it's all about, and that's what gaps are. But yeah. Gap it up, baby. Gap me, daddy.